We have just seen the biggest one-day move on the Nikkei 225 since 1987.
It's Monday, August 6th. In many markets, stocks, cryptos, and commodities around the globe opened severely in the red, meaning huge losses for companies and investors.
Be opening actually now, as after a global sell-off, European and Asian markets plummeting around the world. And we've been looking at futures, and they were more than 1,000 points down.
Japan down over 20%, and as you're pointing out, the Nasdaq could even, decline further.
In the latest bout of sell-offs that are shaking the world markets.
Billions of dollars have been wiped out of the U.S. stock markets. The S&P and major U.S. stock indices had their biggest fall in a single day in 2 years. Even major banks in the U.S. had significant sell-offs of their stocks. Why does anyone care about stocks falling?
Why do I care? Why do I care?
Well, it can be a huge indicator that something's going wrong in an economy. Stocks are a way of companies to raise money from the public. The company trades a small portion of their business, called a stock or share, to raise money, ideally so that they can reinvest that money into the company. When the company does well, usually it attracts investors to buy the stock. If a lot of people buy a stock, the price increases and becomes profitable for the investor that bought it low. When people sell the stocks, the price of the stock goes down and people can lose money. Indices are usually a basket of many major companies' stocks where people are able to buy and sell from. They can be a leading indicator as to how well an economy is doing. Sudden crashes in major indices could be signaling something bad happening in the broader economy. So the question begs, what caused the global markets to drop so abruptly? There was one very apparent thing that influenced the sudden crash.
Japan's benchmark Nikkei 225 stock plunged 12.4% on August 5th in the latest.
There's some breaking market news in Japan and Europe, news that will...
And Japan's Nikkei plunged 12.4% today.
The sharp drop in the U.S. stock market on August 5th, 2024, followed the Nikkei, the Tokyo Stock Exchange, which had started selling off in very early hours of pre-market trading, signaling a broader fall in the rest of financial markets. It resulted in a major drop in prices of over 12% in a single day for the overall Tokyo stock market.
And we know when the Nikkei is not doing well, it causes the Nasdaq to start getting a little anxious.
Which was the worst fall since an event called Black Monday. Black Monday was a day when stock markets around the world suddenly crashed, causing panic among investors. It happened on October 19th, 1987, when the U.S. stock markets, along with others around the world, lost a big chunk of its value in just one day. Reasons for the crash included things like fear of inflation and concerns about how much debt the U.S. was accumulating from trading with other countries. On August 5th, 2024, Japan had just suffered the worst day since then.
The 12.4% loss on Nikkei was the worst day for the index since the Black Monday of 1987.
The Nikkei crashed after the Bank of Japan, or BOJ, decided to raise interest rates for the first time in 17 years. The BOJ has kept ultra-low interest rates on government debt to combat deflation and try to grow their economy. When the BOJ does decide to increase interest rates, something is up. Because keeping a low interest rate is extremely profitable and stimulates their stagnant economy. But hold up.
Pause.
Why does it matter what the Japanese economy does? The Japanese stock market and the US are particularly entangled. Japan is a global liquidity provider. Low federal interest rates makes borrowing money in Japan relatively easy. Other countries, like in the US, have higher borrowing costs. And as they raised interest rates to combat inflation, it became much harder for people, businesses, and institutions to borrow money. This in turn slows down the economy. It takes liquidity or dollars from the markets, and less dollars in circulation lowers the rate of inflation. I just want to touch on inflation really quick because I want people to understand what it actually is. In simple terms, inflation is directly tied to the amount of dollars in the economy. Too many dollars with nothing to back the money, since we're no longer backed by gold, makes each dollar lose value. The prices of everything else increase to balance the value lost from each dollar.
The government printed more and more money. Before long, everyone was a trillionaire.
Back to Japan, they had a completely opposite situation to most other G20 countries. It pretty much has its own unique set of economic circumstances.
Economists sometimes say there are 4 types of economies in the world: developed, undeveloped, Argentina, and Japan.
Instead of inflation, they were experiencing deflation. According to Investopedia, deflation is when the money supply contracts or there's less money in circulation. Prices of goods and services fall, which in theory sounds good, but essentially this means that the economy isn't growing much because there is less money for businesses to lend. If the economy isn't able to produce at a large enough scale, unfortunately, it also devalues the currency. Deflation is considered much worse than inflation. The yen had experienced deflation for decades, and the Bank of Japan had no other choice but to keep their interest rates low to stimulate their economy in the attempt to drive growth. Low interest rates makes it easier for people and businesses to get loans. High interest rates would make it harder. These low interest rates were attractive for foreign investors to get loans from Japanese banks with little interest. The Bank of Japan had their rates set around 0%, so investors could get loans from other banks slightly above 0%.
Because it creates a downward spiral of self-fulfilling recessionary expectations by discouraging borrowing.
In the US, for example, people have to pay anywhere from 5 to 10% interest on a loan, but in Japan, they could pay less than 1%. Foreign investors would acquire cheap, low-interest loans from the Bank of Japan in yen, and they would sell their yen for dollars, which would lower the price of the yen even further. Then they would buy US Treasuries, which produced roughly 4 to 5% return. US Treasuries are considered to have a secure return on investment as long as countries, institutions, and investors invest in America, then people will buy their debt. It's a reasonable investment because US holds the reserve currency status. There were a lot of risky trades happening because of these cheap loans from Japan. Many traders would take on high leverage trades. In a leverage trade, someone borrows money to bet on the price of something like a currency moving to a certain level. If you leverage a trade and it goes your way, you can make multiples on the trade investment. However, if your leverage trade goes the other way, you can also lose multiples. There were a lot of heavy bets on Forex, trading the dollar versus the yen. The exchange of yen for dollars is known as the carry trade, and it was extremely profitable for many investors globally for a long time. It also meant that the US and Japanese economies were heavily intertwined, and any substantial changes within one can affect the other. However, something was brewing in the background that would cause huge shifts. Japan is one of the most import-dependent countries in the world, with over 90% of energy imported and over 60% of its food. Since they depend very highly on imports from other countries, many of which are experiencing inflation, that inflation came to Japan as well. The government turned on its money printer because it's taking more yen to buy outside goods. The cost of living was increasing and wages had to be increased for the first time in decades. So the country joined the inflation club. There were a lot of inflation concerns of the US not being able to control their rising inflation. The carry trade came unwinding when the Bank of Japan was forced to increase interest rates on their debt. Wages were rising, the cost of living was rising, and the only way to combat inflation under the current model they use is by raising interest rates to slow down the demand for debt and money creation. But as interest rates go up on a federal level, they also carry down to the rest of the banks. Now, instead of having a 0.1% interest rate on loans, you have a 0.25% interest rate, which means that you are pocketing less money and you have more debt. So investors start to panic because when these markets shift, they do it quick.
Soon after, unexpectedly lackluster jobs data from the U.S. sparked fears the Fed had waited too long to start cutting rates.
As investors start to panic, it creates panic selling of stocks and holdings that are considered a little more risky, like major tech stocks, to protect their money. This initial selling then creates more panic selling. And for some people, they get liquidated from their positions because the price falls so abruptly that the markets force them to sell. We see in the charts huge red blocks.
New applications have hit an 11-month high, which means fewer jobs are being generated.
In the US, Jay Powell, the head of the Federal Reserve, the people who control monetary policies in America, called for an emergency meeting where he had to calm down the market to avoid a recessionary crash that would be scary for investors. The Bank of Japan also held a special meeting where, after talks with the Federal Reserve, they had to announce that they wouldn't lower rates anymore.
The Bank of Japan actually came out to say that they wouldn't raise interest rates again if markets were unstable.
A few months after the sharp sell-off, the carry trade is still looming, but we're not talking about it. Right now, the markets are doing extremely well and will likely continue to perform going into the rest of this year. Even though Jay Powell and the BOJ say everything is okay, there is no indication that inflation in the US will cool off. In October, we had a bad inflation read where year-over-year inflation actually went up by 0.1%. The last few readings have seen roughly a 1% difference in inflation by year. Unemployment ticking up could be what starts a recession. It's not all bad though. Crashes can be good opportunities to buy your favorite stocks, cryptos, and assets if you know how to take advantage of them. Keep learning how money runs the world.